All right, quick trip back to 2008. The economy looked unstoppable. But under the hood, it was leaking oil, 'cause cheap money. After the early 2000s, interest rates dropped. Borrowing got easy. Mortgages got easier. Even for people who couldn't afford them. Effect: a housing boom. Home prices shot up. Everyone felt richer. Banks started handing out subprime loans, risky mortgages with teaser rates. Lenders bundled those loans, mortgage-backed securities, CDOs. They sold them everywhere, 'cause risk was disguised. Rating agencies gave high ratings. Investors trusted the label. Pension funds piled in, banks piled in, governments piled in. The machine kept spinning. Effect: demand spiked. More loans, more houses, higher prices, a bubble built on sand. Cause: adjustable rates reset. Teaser payments jumped. People missed payments. Foreclosures ticked up. Effect: prices stopped rising, then started falling. Owners walked away. Markets flooded with homes. Prices fell faster. Cause: bundles full of bad loans. Investors noticed. No one knew who held what risk. Trust evaporated. Effect: liquidity froze. Banks stopped lending to each other. Funding dried up. March 2008. Bear Stearns collapsed. Cause: leverage. Big banks borrowed huge amounts. Small losses wiped out capital. Effect: September 2008. Lehman Brothers failed. Global shock. Money market funds broke the buck. Stock markets plunged. Credit lines snapped shut. Cause: contagion. One fall could topple others. Effect: full-blown financial crisis. Jobs vanished. Savings shrank. Homes were lost. Not just Wall Street. It was every street. Response: governments and central banks stepped in. Emergency rate cuts. Massive liquidity injections. Bailouts and guarantees. Stress tests. Dodd-Frank. Higher capital requirements. Consumer protections. Scars lingered. Years of slow recovery. A trust gap that still echoes. Lesson: cheap money plus risky lending, chaos danger. Hidden risk plus leverage, chaos system shake. Simple chain, cheap credit. Risky loans, complex products, hidden danger, rate resets, defaults, falling prices, panic, leverage, contagion, crisis. Today, names and tech differ, but the physics of finance hasn't changed. What's the real risk? Who is holding it? How much is borrowed to get it? If answers are fuzzy, be careful. Bubbles don't pop slowly, they snap. Echo lasts for years. That's the 2008 financial crisis. Cause to effect, step by step. Next time the music sounds too good, listen for the ticking underneath, because it's always there.